Welcome to this edition of MDM Live today, April 10th. Thank you for joining us. My name's Tom Gale, and I'm the CEO of Modern Distribution Management. MDM is a market research and media company that provides market intelligence, trend analysis, and market analytics tools focused on wholesale distribution in industrial markets globally. Our program today is sponsored by VersaPay. VersaPay ARC automates the entire AR process, invoicing, payments, collections, cash app, bank reconciliation, and more. In today's economic situation, ARC enables distributors to get paid, streamline financial operations, and manage cash flow. Visit versapay.com for more information. I'm joined today by my co-host, Mike Marks of Indian River Consulting Group. Mike, welcome.
Thank you, Tom. It'll be interesting to see what happens. I like who we've got today. It's pretty exciting.
We've got a great lineup today. And in our first hour, I know we're going to kick it off and we're going to talk a few minutes. You've got a slide in terms of what you've been picking up and hearing this week. So we'll do a little bit of recap and some of the things that you're filtering out and distilling. Then pretty quickly, we're going to bring on Brent Grover. And then from there, after that, Charley Hale will close out our first hour. Charley is the CEO of Motion and Control Enterprises. And after that, our second hour, Doug Savage of Bearing Service will be with us. And then Sam Petillo with Singer Equities. And we'll wrap up the second hour with Reed Anderson of Houlihan Lokey. So a lot of great people. And I know our conversation will be fantastic again today. You know, Mike, this is our third week since we launched MDM Live. And our intention was to really provide a resource for distribution leaders to hear from some of our regular contributors and others, and also really from a lot of distributors out there to hear the latest really in terms of what they're doing to respond to the COVID-19 epidemic. And really what it's become is it's become a nice forum for people to really get some ideas, to triangulate what others are doing, and just I'm delighted again for the third week we've got more than 500 people who are joining us. So again, thanks everyone. So Mike, let's kick off and how are you this week?
I'm what's the old thing? A one-legged man at a butt-kicking contest. I'm looking forward to the weekend because I really need a mental health day. It's been one day this week. It was at 9:30 at night, and I'd been on conference calls since 6 in the morning, and I was still sitting. I hadn't shaved, and I was still sitting in my pajamas. I'm thinking this is really goofy.
Can you put your volume up a little bit anymore, Mike? Or is that it?
I think that's it. Is that better if I get closer and use my outdoor voice?
Yeah, if you get up close and personal, and I don't think I've ever asked you to use your speaker voice before.
Wow. Okay. Well, I'll see if I can get it going. It's the same setup we had last week, so
it's good.
All right. So in any case, everybody's going through crazy times, and we've had conversations this week with distributors in Asia, India, Spain, Italy, Germany. Dubai. I mean, it's just everybody's in different stages of this thing, but they're going through crazy stuff. So I put together a couple of slides just on some stuff I bumped into this week. Do you want to share them, Tom, or do you want me to do it?
Go ahead, Mike, please.
All right. We're taking some risk here. We'll see what happens. Let's see if we can do this.
We're on the live high wire.
Woohoo. Can you see that slide?
Yeah, if you go to presentation mode, it's fantastic now.
Okay. A lot of people are dealing with reductions in force and the rest of it. And I want to talk a bit about the difference between layoffs and reductions. And there's two things that are important in this thing. We're number one, trying to protect our team, our employees. And number two, we want to be as strong as we can when we kind of get through all this like shock and awe and we getting back to regular competitive business. So the company needs to preserve strength, but we also need to reduce costs. So this came across from a company. I'm going to be nice and not mention names, although it's a really squared away company. This is how they laid it out to their employees, because they started to say, are we going to lose jobs? And they had gone through and already done a salary reduction program where the CEO and direct reports went down 30%, Their direct reports underneath that, the directors and so on, went down 20, and the employees went down 10. This is to preserve their profit for the year, or at least to get it close enough. The one exception was people that were on the front lines had no payroll reduction, no 10% if you're in a warehouse. But when they were talking to employees and trying to answer the question they get laid off, these 4 steps were really important. Actually, last week there were 5, but the federal government on the FFCRA program actually changed the rules on Tuesday. But they told the employees that assuming the demand is still there, obviously everybody's still working and doing what you need to do. What they did is they put through, every department came up with a list of productivity improvements. And they basically said, if we were going to make ourselves stronger coming out when we come back, what can we do to streamline and be more efficient? And so what happens if the work activity drops off, they would assign them to productivity improvement activities to make them stronger. If they didn't, then they talk about a work transfer based on their skills and so on, in terms of, can they work in a warehouse? Can they work in finance? Can they do some of these other things? And then if they exhaust that, then the last step would be talking to them about sick leave, vacation, and the rest of it in terms of how this goes. And by the way, in terms of being able to get the paid sick leave, if an employer does not have work for the employee, they can't obtain the federally paid sick leave. So the key thing here is trying to let people know what's going on. Transparency seems to be the word of the day in terms of, if you want to do it right, you want to lead right, everybody's got to know what's going on. But I want to make this point here. There's a very big difference between a reduction in force, which is the classic layoff, and a furlough. And the difference has to do with the management intentions about rehiring people. And by the way, again, honesty and transparency really work here. But there are companies that when they do furloughs, they still have human resources reaching out to the people weekly on a furlough, doing calls, giving them updates. And so if you're furloughing employees, you basically say, our goal is to bring you back when business conditions return. You may have some very specific numbers, but you put those into an index because you may not want to share them publicly. But you tell people on the furlough list when you're doing your call, look, we're 72% of back to our goal. As soon as we get to 100, we'll rehire. We'll keep you posted. So, and by the way, there's no obligation to an employee or an employer in that. It's a statement of intention. Now, the reason this is important for distributors, there are circumstances. We've actually got situations that will remain nameless where we had distributor branches that are actually completely closed now, where all the staff is self-quarantining. They don't have a backup for it. We've actually had a large DC close for a big distributor, which is very painful because there's a lot of product that goes through a DC. But the idea is that some companies have actually furloughed. If the branch activity is down, they furloughed half the employees and then basically set up, like in the Navy on a submarine, the blue and the gold team so that they can swap. And the idea is that once somebody gets stuck and that team has to self-quarantine, you can still keep the branch open and going. There's a lot of thought that people are putting into these creative things. A couple of the things that went into that was paying a premium to frontline. A lot, Amazon's deal got a lot of visibility. I've seen 2 deals where in the warehouse, they put teams together of 5 people, and they said, if the 5 of you can manage and not get sick, there's no guarantee. We'll throw a bonus in at the end of each month if you guys can all stay going. But understand, people are going to get infected, but just try to give them a reason to have a little extra caution. In terms of the work that we've been doing with companies in terms of cost reduction, the numbers I have down here are kind of, they're not rigid, but it's a starting point. If you have to take costs out and you go through and you're doing a stress test on your business and you say, I can't get there from here if it gets that bad, the gap is typically being made up so far of 65% payroll reductions, 10% margin, and 25% non-payroll, sort of the death by 1,000 cuts. One thing on this DC that got closed, they didn't have any cleaning procedures in place. There are some distributors that actually have teams cleaning their warehouse every 2 hours and going through, so it's a constant deal. But these other folks, they're now closed up and they can't get the contract cleaning company to come in and clean it because their contract cleaning companies are horribly busy. So the whole thing just gets really, really difficult as we go through and do it. So let me unshare my screen and we'll go back to How do I unshare?
It's probably up at the top of your screen, Mike, a little green bar, maybe.
Oh, yep, there is. Stop sharing. There we go. Thanks, Tom.
Perfect. Thank you. And with that, I'm going to bring on Brent Grover. And I also just want to make a note that we will be sharing a link in addition to a link to the recording today of this program. We'll also be sharing a link to Mike's slides there for reference if you'd like to take a look at them as well. Brent, stand by one. And it's a good thing your name begins with B because I can get you to quickly on the list and bring you up here. So I guess from now on, we just have to invite people with the first letter of their names of A or B, and then we're all learning Zoom right now. Welcome, Brent.
Hey, Brent. Yeah, you're still on mute.
Yeah, and I may need to, that's probably my my learning curve. Stand by. Now I think we should hear you.
Are we on the air?
We are on the
You're
air.
good, man.
Great.
You're good.
Yeah, welcome. So just as a brief introduction, Brent Grover is president of Brent Grover and Company. He has been a long time, you know, I use the term consigliere on the promotion for this, Brent, and I thought that was pretty appropriate because you have.
I wanted to ask you about that. Were you thinking of Tom Hagen, Robert Duvall's character? I hope I haven't lost that much hair yet.
No, actually, I was thinking more along the lines of Bill Campbell out in Silicon Valley. So
that's better. Okay.
You're looking good, man. I like the beard. Looking
Thank you.
Good.
Thank you.
Yeah, it's a pleasure to have you on board, Brent. And you know, you've written 8 or 9 books for NAW. You, along with Mike, are a fellow of NAW's Institute for Excellence, and you've done many other things. So with that, let's just kick it off. I guess how are you doing, Brent?
Thank you. Nice to see that everybody is maintaining a good sense of humor. We need that, even if we don't have much else. Ordinarily, I'd be in Florida, but I came up here to Cleveland because my wife and I wanted to sequester with a couple of our kids for our amusement. I think by now we're all questioning the wisdom of our decision. You know, I'm still on some company boards in wholesale distribution, so as I know Mike is also, and I've taken the initiative to ask the CEO and the CFO of some of these, well, all of the companies, to meet with the outside directors via a medium such as this. Zoom is what everybody's kind of moving to, it seems, and for good reason because it works so well. Anyway, these conversations, when you're just limiting it to the CEO and the CFO and the outside directors, I don't have a lot of posturing going on. It's just mostly, in my case, asking questions about cash. First and foremost, you know, I'm the recovering accountant. I always remind people of that. And the old story is, you know, when you have plenty of oxygen, you don't think about it. When you're running out, you really think about it. That's very relevant to the COVID-19 world. But also running out of cash is something you don't think about it too much, but when you don't have it. And one of the cash issues that I wanted to mention is the expectation that companies have from the PPP, the CARE Act. I think, based on what I'm hearing so far, a lot of people are going to be disappointed. They've got their applications in and they're pleased about that, but they don't know what they're going to get yet. And I think there's some disappointment there. And I don't mean to be political because I'm not knowledgeable about, you know, how much more there is to get beyond the initial amounts that have been provided by the lawmakers. But I am concerned. And to follow up on that, I think the companies that jumped in with their banks early on and drew down on their lines of credit were wise to do so. It's good to have that. You know, some distributors are hamstrung a bit when they draw on their line of credit. You know, the bank has an agreement where it immediately gets applied to their line of credit. It's a sort of a circular equation. Unless you take the money out and put it in another bank or bury it in the backyard. So the other levers that we have to pull, other than government funding, interest-free loans and non-repayable loans and bank credit, are the typical levers we pull in our businesses, that it being inventory, receivables, and payables. And I'm hearing from not only the companies which I serve as a director, but also I have a core group of CEOs and CFOs of some larger distributors. When I say larger, 500 employees and up, not talking about publicly held companies, but private equity owned, ESOP owned, wealthy family owned distributors. And what I'm seeing with them is, of course, there's the inventory level, very significant destocking going on, maybe the biggest destocking in the last 10 years, depending on the industry. And of course, very much depending on the industry. Receivables, I would expect that there's going to be a significant slowdown on the money coming in from customers. Landlords are getting a lot of that pushback already from their tenants, and that's to me an early warning system there, where people are going back to their landlords and saying, sorry, I can't pay it for a while, or asking for an arrangement. Maybe they'll extend the lease in exchange for some free rent now, et cetera. But I think distributors are going to face that. And I've also heard some distributors say that they have stopped paying their suppliers. And that's only going to go so far. One of the big issues there, and I've encouraged it, trying to exchange some change in terms. Maybe if we have 2% 60-day terms, we could go to 1.5, 90, or so. There should be a quid pro quo of some kind. But it's hard for a distributor to improve their suppliers' security with the money. As in other words, you want to give them a personal guarantee. That's not usually practical or even possible. But the question there I concern myself with is not paying means not getting cash discounts that are needed for profit, and also not getting or risking not getting rebates. Sometimes the rebate programs are predicated on prompt payment, and there could certainly be a lot of pushing and shoving. I know there already is a shift away from focusing on profit to focusing on cash flow. And, they're not the same thing. And I'm not talking about the differences having to do with depreciation or income taxes. The thing I'm talking about specifically is the way we manage inventory, receivables, and payables. Normally, when our business drops off in distribution, the cash box gets filled up again because we sell inventory and we have a reduction in receivables as they get liquidated. I'm not so sure they're going to get liquidated. I want to stay on track here, Tom, so I'll go into other topics, but I want to check back with you to see if we're talking about the things we should be discussing.
Absolutely, Brett. Last week we touched on just what you were talking about a little bit in terms of this the quid pro quo and the relationship with suppliers, and specifically around really just how flexible some are or aren't.
Yeah.
And as we move through this current period here and come out the other side, there's going to be a lot of rearrangement of deck chairs in terms of
Right.
the depth of relationships and choosing up sides in both directions, really. And I guess as long as we're on that, I mean, we've talked about this before, but really around the need to focus on your core suppliers and from a from a profitability standpoint, efficiency and cost to serve standpoint of not carrying a dozen lines and really trying to rationalize some of that. And how do you see this coming out whenever we do come out of this?
Well, I think there's already an indication that some suppliers are maybe loosening their former restrictions on who they're willing to sell to. They need business, and a company like, I use as an example here, let's say a Grainger supplier that didn't want to sell Zorro tool, maybe they'll decide now that that's okay, that they'll open up the doors a little bit. Mike, you're nodding your head, so I think you may agree with me on that. But
I do.
Inventory levels are too high, and there's a lot of destocking going on. And this is going to freak the suppliers out. I mean, there's some serious issues coming, and it's not just the distributors, we're not in this channel alone. You know, it's a pipeline, right? And there are our partners. Pricing, a good question. You know, I would always, in this case, think that pricing could be weak. I would say at least it's flat, and any increases would be very, very hard to justify at this time. Unless material costs go up dramatically. Obviously, copper goes up and wire costs more, but tell me which commodities are going up in price right now. I don't know what you might be thinking of. I didn't mention the M&A world, and I meant to, and I know that's a topic of another speaker in this meeting, so I won't try and say too much, but I do have some involvement with the private equity world. I think where the private equity funds were saying just a few short weeks ago, their biggest problem was dry powder and deploying the money that the investors had given them to invest. And I think right now they're on DEFCON 4. The whole deal there is totally upside down. Their portfolio companies are, most of them, unless they happen to be selling safety supplies, which that's a nice business to be in right now. They have big issues, and you know, I would say there's going to be a tremendous decline in decline in exit value. You know, we've been riding high for a long time, and we could tick off all the reasons. You know, interest rates are low, and the stock market's high, and this. Well, it's all changed suddenly, and I think there's going to be an activity plunge. And, you know, maybe the next step in this is going to be bottom fishing, but there's by that I mean going after companies and trying to get them at, you know, super good prices for the buyer, not so good for the seller. But I think the seller's market we've enjoyed for 5 years is going to be a buyer's market for a foreseeable period of time. And I can't go into any specifics. I don't want to. I think we'll leave that to the other guests you have in the program.
Yeah,
later.
but Brent, you have a unique perspective just in terms of, I know a lot of your advisory is around M&A, and
Right.
particularly for the smaller independent distributors, and you've done that for quite a while. And I guess from your view, you know, it comes back to the balance sheet. I mean, for a small distributor who has a strong balance sheet, this is also a good opportunity potentially because some of their competitors in their markets are likely to be in a position either for an asset sale or you know, just will be in very difficult, you know, I mean, there's opportunities out there, I guess is where I'm going.
Well, in the last 12 months, I'm happy to say that I was involved in 5 different transactions involving sales of distribution businesses to private equity, or in one case, strategic transaction. And, you know, the sellers were thrilled because the deals were so great and exceeded their expectations. It didn't take as long as they thought it would take. It wasn't as difficult. You know, those are all flags. And now I think we were working on 2 programs with overseas companies buying US-based distributors, one in Europe, one in South America, and also 2 projects involving distributors who wanted to sell their businesses for the usual reasons, usually, you know, family related. That's all, everything's on hold. I mean, nothing's happening right now, at least not in my small world. So, you know, big change.
Brent, this is Mike. As we've been doing some stress testing with clients and stuff, we're finding that more times the distributors bump into blowing a covenant than running out of cash, you know, where the bank gets in trouble. And then talking to a couple of folks on the PE side, you know, if they've financed an acquisition with 60% debt, it doesn't take very much to blow a covenant. But I've heard people say that the banks don't want the keys to these businesses, so they doubt that there's going to be any forbearance. I mean, what's your take on that?
Yeah, I think that's a good question. I think the first evidence I'm seeing is that distributors going to the vendors and saying, look, my banking arrangement, asset-based lending is the usual way that goes, you know, inventory receivables. I would like you to ease up on my slow moving inventory as far as whether it qualifies as collateral or not. And that's a negotiable point. Another one is on my receivables, my past due receivables. I want to loosen that up. And there's been some cooperation from banks on that. As far as them, willing to sit down with you and start to write commitments to waive covenants before you get there, I don't think bankers are going to be too likely to do that. They face their own potential problems from the controller of the currency. We've seen that before. So they can't make commitments they can't back up. But I think you make a really good point, Mike. I think the real big question is, I don't want the keys if I'm a lender, even any more than I wanted to have a landlord hand over the keys of a half-empty building when there were no tenants. I'd rather that the landlord keep the building and we'll work it out. We'll restructure the debt, et cetera. So I would say, yeah, they'll probably do a lot of debt restructuring. But my big concern with the distributors is the value of their collateral, inventory and receivables, and their advance rate, which could typically be 60% on qualifying inventory, 85% on qualifying receivables. That could really be up in the air. And what will happen is to say, even though interest rates have gone down, distributor interest rates may go up because they're going to have to compensate the lender with a bigger spread.
Oh,
I'm just talking about the spread, not the base.
Oh, yeah, right. I understand.
Right. These 225 basis points over LIBOR, these deals will be going away. I would argue, for those who need covenant relief. Okay.
Well, and I've got to believe when you were talking about your 5 transactions, that those are probably 5 extremely happy people right now.
I'm getting a lot of thank you notes.
Yeah, timing's everything.
Yeah, that's for sure.
I'd like to get another take from you, if you wouldn't mind, and because I know you touch a lot of distributors, and we've seen there's a few that have already gone through, adjusted the cost, gotten everything trimmed up, and they're already in battle mode where they're just used to it. There are others that are still stuck. I mean, what's your sense of have most of the distributors you've seen been responsive enough to these events? Or are they lagging behind? What's the pattern look like?
Well, I'd like to think that all of our clients are the smartest people in the business, so they're all way ahead on this. It depends, Mike, on a couple of things. I think the private equity run firms are all over this, okay? Because that's their cup of meat, really, is dealing with these types of issues. I think the ESOP firms, it's a little harder for them because, the employees are the owners, and it's hard to lay people off at the same time that they're shareholders. And that's kind of a different kind of a deal. And I think, like I said this earlier, if you're in the safety supplies business, it's great. Your business is up 20%. You're actually calling suppliers and say, hey, you got anything you want to get rid of? Because we can sell it. People who had a lot of dead inventory, they don't have any dead inventory anymore. Their problem is they don't have inventory. And I even, to get specific here, because I could talk about a publicly held company. Fastenal is a good example. They're going to report their earnings on the 14th. I think that's next Tuesday. Safety is nearly 20% of their sales at Fastenal. So, they had to close a lot of maybe all their branch locations, depending on the state. But they have employees out in the field at their customers with their, and they have their vending machine programs, and that's like custom made for distancing. Big problem though is they're very tight on inventory management there, and they may have orders they can't fill, if they don't have the inventory on hand. And I understand, and all distributors have to deal with this. Customer comes to you and wants terms. If you've got the flexibility financially to give your customer 60 or 90-day terms, I don't think you're going to want to be very aggressive on pricing. I mean, you ought to be able to get it through margin. So, to answer your question, I think it depends on then what's the position you are in the marketplace. If you're selling government healthcare paper and pulp, you're in pretty good shape. If you're selling oil and gas,
go home.
you got another kind of problem. And if you've got inventory, but most importantly, if you've got money. So I would say the ones that are the most proactive are the ones that are worried about their cash. When they're talking about having 60 or 45 or 45 days of cash, that's a real call to action. Others who are, more comfortable in terms of publicly held companies, and Grainger's, I think, have been in a pretty good spot. Safety's a big chunk of their sales. They're largely selling the right markets. They have huge advantages with electronic commerce, getting share gains there, and selling MRO is better than OEM right now. And, those guys, and I don't know what's going on at Grainger other than what I read, because it's just a publicly held company, not a client, obviously. But I think that the one thing that I would say is the companies with good CFOs, strategic CFOs, those are probably the most important executives in the company right now. And if they can get the chief sales officer and the chief operations officer and the chief marketing officer to line up, they're probably going to be ahead of companies where they're having internecine warfare over what they should do. Are you still making retirement plan contributions? Have you cut off your capital projects, capital expenditures?
Hey, Brent, can you
that ERP project? You put that on hold.
Brent, can you just reset back to where you started talking about your last statement? Because you had a little cut out there, and you're fine now. But I just want to make sure people caught that last thought you had.
All right, the CEO, obviously that's the main person in a company, but I think the CFOs are in the most important chair right now,
right,
at the C level in these companies, because the CFO is the person who's got the overall view of the cash flows at the company, and they need alignment with the chief sales officer, the chief operations officer, the chief marketing officer, so that they're working together and not having intramural fighting over capital expenditures and whether or not they want to go ahead with the ERP project, what have you. I think a strong strategic CFO right now is the most valuable player on the team. Thanks.
Yeah, I appreciate that.
I got one more. I'm not sure where we are in time here, but
we're good.
In terms of the paycheck protection thing, Brent, we went out like a bunch of other people, and we're in the queue with zillions of other guys. I only know one distributor that's actually gotten their check yet. But we took the view that we only wanted to get enough money that was forgivable, but our CPA is coming back and saying you should get the maximum that you can because you don't know what's going to happen. I mean, what advice would you have for distributors in terms of those going after the money?
Yeah, I have advice on that, which would be listen to your CPA. I had a meeting with a CPA firm this morning on that topic, which is, this is a service for clients. And how many clients out there are going off and trying to do this on their own, and they're relying on their banker, which of course, the banker is part of the team, but the banker is a lot of other people trying to get after the same dollars. And I think the CPA is more able to find opportunities, let's say, to get both pieces of that, both the forgivable and the, what's the old story, right? Ask for forgiveness later.
Yeah, you're right.
That's my advice.
Well, just my own personal anecdote on that is that we went to our primary bank and got their form, and our CPA took a look at it and said, they're missing a few things here, and came back and basically we were eligible based on what our CPA told us for about, I'd say close to 40% more than what the form that our primary bank said we were eligible for. So we went to our secondary bank, and obviously we applied there. But this is not figured out by a lot of people at this point. There's going to be a lot of moving pieces here going forward, I think. So that's great advice.
Ask your CPA firm first, do they have their money yet? And if they say, yeah, then you got the right one.
Absolutely.
That's perfect. That's perfect. And by the way, my big takeaway is that my CPA has been telling us something different than the bank. So based on what you just said, I'm going to listen a lot closer to our CPA.
Listen to that. They're the right ones to ask right now, in my opinion. So, Tom, I think I'm getting close to the end of my time here. I just wanted to wrap up.
We've got about 3 or 4 minutes. Brent, let me just, I've got one question for you. And I also just want to clarify, somebody said, Tom, did you get the money yet? And the answer is no, we applied, I think it was, we applied this Monday. Have not seen it. You know, we got the confirmation, but it's, I mean, it's with Chase. The money that we haven't got, the check has not arrived. It's still in the mail.
Well, the bigger banks are, of course, they're tripping over each other trying to get this done, aren't they?
Absolutely. So, Brent, I want to give you a couple minutes here. I know you had a couple thoughts you want to make sure you touched on.
I wanted to just think ahead. You know, I know the Economist brothers did a show this week, and they talked about, you know, the ITR with the good advice they usually have, talking about, you know, looking at the fourth quarter and things are going to get better, and then you know, the sun will come up tomorrow and all that. And I appreciate what they had to say. So I'm not thinking of an economist. I'm not going to guess on when. The old story with economists is give them a number, give them a date, but don't give them both, right? So I don't know when this is going to happen, but here's what I think is likely to happen. One is an accelerated deterioration of the weakest firms out there. And, you know, some of them were kind of a lifestyle business, and I'll hang on for a couple more years or 5 more years. I think that time is going to be compressed. I think there's going to be an acceleration in the transition of sales teams. Maybe there are going to be some folks who decide who should have retired a long time ago, or maybe they already did, but they're still on the payroll, that they're not going to be around anymore. I think there's going to be a rapid acceleration in the adoption of e-commerce. If anybody didn't believe it before, you found out, guess what? It works really well. Another thing is an acceleration of the streamlining of businesses, getting rid of redundant branches, and getting rid of non-performing people. And I've heard more than one person say, and I definitely wouldn't say who, that we let some people on go, and we have no intention of bringing some of them back. And I don't think that should be terribly surprising. So as far as deceleration, I think a rapid deceleration of M&A at premium prices, a deceleration of interest of PE firms investing in this industry, because it's going to be destabilized for a while. Certainly a deceleration in CapEx projects, and that may well include ERP implementations. You only want to do an ERP implementation from a position of strength, not from a position of weakness. And a deceleration of cash flow for sure. And I believe a lot of companies are going to, I said this before, I'm going to repeat it, are going to reduce number of branches and realize that they don't have to have as many physical locations to take care of their customers as they always thought they needed. I wouldn't want to be a landlord right now, folks.
Yeah, absolutely. Let's finish off with one question here. And what about more opportunity for consolidation, acquisitions?
I think there's going to be the acceleration of consolidation will be that the big guys with the deepest pockets will be able to pick and choose more or less what they want, and will be able to make those acquisitions at prices that make some more sense to their shareholders and their lenders. I think people went too far when they were paying multiples that gave them a low return on investment. And I think that nonsense is going to be going away for a while.
Yeah. Brent, thank you so much. As always, a pleasure to visit with you, and best of luck.
Thanks. You too, guys. Great to see you.
Take care, Brent. Good to see you, man.
Good to see you.
Take care, man.
I'm going to bring up our next guest here, Charley Hale. And while I do that, just as a program note for next week, I am delighted to, we're going to be talking with some great guests next week. It's going to include Jennifer Murphy of Net Plus Alliance. Christian Wiltrout with SureWorks, a safety distributor, master distributor out of Canada, but has very strong and growing operations in the U.S. as well. Also a manufacturer of some safety products, and they're absolutely on the front line, so we'll hear more about that. Also a fellow at NAW, will be with us next week too, Mike. So
who's that? You dropped out.
Mark Dancer.
Oh, cool.
Yeah. And
fellows getting together.
Yeah, and then also we'll have Henry Bruckstrein with Campaign Stars. We're going to come back to the whole sales transformation and the need to really make some adjustments in terms of, and it's what Brent talked about in terms of more digital support to the sales process and really starting to transition what that looks like. And so Henry's got some great ideas around that and how to strengthen that aspect of things. So with that, Charley, welcome.
Welcome, Charley.
Hello, how are you?
Doing great, man. It's Friday. It always helps.
Yeah,
that's right.
And Charley, just as a brief introduction, you've been a long time contributor and friend to MDM. You've been on our advisory board for a number of years. You were also for a long time at FCX Performance and really drove the growth in that. A lot of M&A experience as well. And now you are the CEO of Motion and Control Enterprises. And if we can just start off a little bit, tell us a little bit about what Motion and Control Enterprises is all about.
Sure. Motion and Control Enterprises is owned by Frontenac. It's a Frontenac portfolio company purchased in 2018. I was the chairman of the board at the time at the initial purchase. Unfortunately, I decided to be the CEO in the first part of 2020. I probably should have waited till next year, but nonetheless, I'm here. Motion and Control Enterprises, we're a fluid power distributor based in Pittsburgh, primarily fluid connectors, hydraulics, pneumatics, 4 locations in addition to a Pittsburgh warehouse, one located in Detroit, Chicago, and Milwaukee. So we've definitely got the Rust Belt covered, and our customer base reflects that. And have a mix of OEM and industrial customers. Obviously in those geographies, we're tied to steel, auto, food, process, generally cyclical type markets. The company, in addition to those 4 distribution centers, has about 20 Parker retail stores. So they function something like a Napa. So we'll go in and we'll sell primarily fluid connectors, hose, and kind of do on-demand fabrication out of those locations as well.
So you've got pretty strong counter as well as traditional branch operations?
We do. It's by far the majority of our business are traditional distribution operations, but it's really supported. And that, I'd say that counter business also supports the distribution business, and then it also focuses on a kind of a local targeted customer base surrounding the store as well. We've got about 200 odd employees roughly. And certainly it's been a challenging. I think a lot of people went into this and, halfway through March, things were looking pretty good. And I think even at the end of March, people felt generally okay. But we, and I think like most other people, saw a pretty accelerated drop in business as we came into that third and fourth week of March.
Yeah. So how are you and your team doing right now?
Fortunately, everybody's healthy. That's a good thing. We do not have anybody that's sick. We've got the majority of our office staff working remotely, which was no small task, but kind of all of our finance, accounting, purchasing, and a great majority of our customer service operations are now done remotely. We've made roughly a full staff in the 4 distribution facilities, and all but one of our Parker stores have remained open. We obviously changed the way we do the counter business, one person at a time in the store, appropriate distancing, and as well as in the warehouse. We've adopted much more stringent cleaning and more regular cleaning, and then making sure we keep proper distance between the people in the facility.
What are you hearing from your customers right now?
Well, you know what, it's a mix. And I think I went through our top customers based on first quarter sales, and about 20% of that revenue base is just closed today. They've shut down for some indefinite duration. And probably another 20% of that is they're on a maintenance only. So maintenance people in, limited delivery, but some basic operations happening. And the others, it's a mix of full operations down to reduced operations. It's certainly, from a sales perspective, obviously our sales guys generally aren't getting into those facilities. The staff, the purchasing staff from our customers have mostly gone remote. So it's caused some challenges. And I would say as we've seen those, we talked about earlier, you were talking about the working capital implications. What we're finding is the payable teams at our customers have gone remote, and they're just really hard to get a hold of now too as well. So we've got kind of just practical constraints, slowing collections, whether planned or not, in addition to just what you would expect to see in this environment.
Yeah. What about suppliers?
Fortunately, we are primarily Parker Hannifin is our
Sure.
largest supplier. We're in pretty good shape. We've had a few delays of some products coming out of Europe, but for the most part, I think their manufacturing footprint has served them well, and we've generally maintained supply.
Yeah. You listened to Brent, I think, and our discussion there, and certainly you've been really active in terms of M&A activity and distribution. What were your thoughts as we were having that conversation?
It's interesting. We've got a great private equity partner, so they're very supportive of what we're doing. And M&A is a key part of the strategy, key part of my background, and certainly one the playbook we want to run here. Interesting, but I would say that it's been pretty consistent with the number of conversations and dialogues we're having. We're also pretty advanced in a couple of those dialogues, so we're continuing to push. Obviously, pricing risk today is difficult, and that diligence process and timing probably stretches to so you can get a more full look at what's going to happen and how businesses are going to react. But we think today's the time. I think we've put together a nice management team. We've got great financial backing. It's time to continue to look for acquisitions, and we will do them where we can.
Sorry, Charlie, this is Mike. I had myself on mute. As we've been talking to folks, there seems, and maybe it's because we're just in the middle of the crunch and everybody trying to adjust to it, but it almost seems like distributors are working with their customers very closely, or trying to, but there doesn't seem to be as much competitive intensity. Somebody doing like 2 rounds of the auction and the big bids and people cutting prices. I mean, are you seeing a pattern like that? Has it dropped off a little, or what's it feel like to you?
I think we've seen, even before this, right? I think we have been seeing, actually across a number of different businesses, we've seen price kind of being second or third consideration. It's could you get it for us? And I think that certainty of supply is still important. And I agree in this time, if you've got it, can you deliver it? Can you support it? Do you have the technical expertise? I mean, part of the value proposition we're driving is that kind of adjunct engineer type, where we're bringing more than just products off the shelf, and we're adding value, and we've got a growing systems business, and that has continued to be active over the past couple of weeks, and we've gotten several large orders because I think of that expertise. And we just got, it's interesting, there was a customer yesterday, it's been a prospect for years and years and years, and they came to us. We had what they wanted. We had the ability to react, and we got a really nice first order. So I agree. I think that, let's go out to a number of distributors. Let's beat everybody down. We've been a big, my background from 10 to 12 years ago, been a big proponent of strategic pricing and emphasizing that value and being really focused on pricing analytics. We're driving that here, and it's working. I think the initial reaction when you have a tough top line environment is to let's cut price and let's extend terms. And I think we want revenue. Revenue is at a premium today, but we don't want to sacrifice the future of the business through making bad working capital decisions or bad pricing decisions.
I appreciate your take on one thing that I don't have an answer to yet. And all of our salespeople are working remotely. They can't get to see customers. And as you said, e-commerce is important, but that's for just selling products. A lot of what you do, that adjunct engineer, you're actually helping people design systems, and it's really hard to do that from a website. How are you guys dealing with that?
You know what? We're using things like this, like Zoom and other opportunities. We're having people walk through their plant, FaceTime, and show us things that are happening in their plan and helping us diagnose. So we're doing, the best we can under these scenarios. It's less than ideal, but it's working. And I think we've been, probably since early February, late January, we've been on this. We talked a little bit about Salesforce effectiveness and efficiency. We've seen those changes coming. I think this is going to accelerate some of those things. So we've really been working about how do we segment our customer base? How do we apply our best resources to serve that customer base? How do we move people to, an outbound inside selling effort? How do we more leverage e-commerce to transact business? So we're in the midst of that, and we kind of had about a 12 to 18 month runway to how we're going to, as we roll through this. This time we're accelerating it. We've really used this time to, we're going to shorten that to a 6 to 9 month transformation. A lot of work, but we can do it now. And it's clearly easier to do it when we're not stressing the system at the top line. So we're driving down that effectiveness and efficiency. We're building our, enhancing our marketing efforts. E-commerce, we've made steady gains, and we've got some additional things that we're adding to that and improving our capabilities there that we'll roll out over the next couple of months. And we've got our salespeople training a lot. We're doing lots of training, whether it's how to use LinkedIn better, how to present product presentations and through Zoom and other formats like this. Technical training, working in partnership with our suppliers. So we're keeping them busy, and we're keeping them focused on, reach out to your top customers, reach out to that next level of prospects, focus on those top opportunities, and doing what we can. Clearly, it's not, the top line isn't where we want it to be, but it could be worse.
Understood. Tom, can I ask Charley one more question before I give him back to you?
Oh, keep rolling.
Okay. The fact that you guys, Charley, you've been very helpful to us, even like back in our sales GPS things that we do with Tom. I know you've been at this a while, so I've got to ask you this question. Since most distributors are talking about sales transformation and not doing it, any lessons, the early lessons from the process you've been in terms of advice you might have for other people struggling with it?
I just do it. I think we talk about it, and everybody else talks about it a whole bunch. And these businesses, quite frankly, they're built around the sales force. They've been generally self-led, self-managed. And we're changing that, and you've got to do it. You've got to have the stomach to do it. I think it's really easy when you get a little bit of pushback, you stop, because you don't want to disrupt those relationships. We're focused on it. We're executing it. We're holding people accountable for it, and I think just doing it. There's no real magic to it, other than it's like pricing, right? If you want to improve margins, you got to focus on it. You got to hold people accountable to it. And drive that process, and it's got to come from the top. I have got to be out leading that and evangelizing why we're doing that. And again, it's not easy. It's probably harder than the pricing improvements that you try to drive. You got to do it.
So it hurts. You don't have to like it. You just have to do it, I guess is what I'm taking away.
That's pretty simple. Yeah, I'm not smart enough to give you anything better than that, other than just work hard and do it.
I hear you, man.
It's interesting though, Charley, because you've got a focused plan in terms of really trying to drive this in the next 6 to 9 months. And I just know many people right now are just so focused on the next 60 to 90 days, that you obviously have figured out a way at least to get some kind of bandwidth. And I just think it's fantastic that you've got this future focus for your team. And it's like, look, this is where we need to get to, and just stay focused on that in terms of a goal right now. Because to me, that just seems really one of the most important things, is to have some sort of a goal in terms of where you want to go and not get derailed right now.
And it's easy, right? It's easy to get knocked out of those. And not saying we certainly haven't been in crisis mode, and we meet daily as a management team, and we're focused on cash generation. We have made some cost reduction in our business. We're, both permanent and furlough, some changes that I think makes this a better business. We know we're going to get to the other side. And when we get to the other side, I think we're going to have a nice pickup in business. We just got to be prepared, and we've got to be optimized to do it. So we've got to balance that short-term crisis mentality with the vision for what we want to do as a business.
Yeah, you've been through several of these cycles. What's different about this one, and what concerns you about this one that wasn't around in the past.
It was interesting. 2008, we were selling FCX to a private equity group in September and October, and we closed in October. And every time the phone rang, I thought the deal was over. So that was a rough time, but fortunately, the PE group held the deal, didn't trade it, and it worked out well for them. I think then we felt a little bit like you could see an end. Like you knew this was going to cycle. You had a rough idea of how it was going to come back, and it seemed pretty simple. You knew what the levers were, both macro and within the business. This has a little bit of uncertainty. It's like you're looking at the abyss and you don't know if you're going to fall off the edge of the cliff or not. And the uncertainty around timing, I think, has been the biggest difference here. It's been really tough to handicap when this thing is going to turn. And so you're making actions. Maybe you're making actions too severe, but I think in this environment, you got to assume it's going to be bad, and you got to assume it's going to be bad for a relatively extended period of time. Position a business to survive that, and focus on the things you're trying to build.
Mike, go ahead. We got time for.
Yeah, I do. Well, I mean, the curiosity. There are a lot of people that are just still sort of paralyzed by this, or trying to figure out what they're supposed to do, or hoping it goes away and we go back to normal. The fact that you guys have pushed this so hard, and I know you've got a fair amount of structure that you haven't talked about getting ready. What's the morale of your team like? I mean, are they afraid? Are they worried about the disease or laying off? I mean, what's it feel like now?
There is a lot of fear. And again, I think it's fear of uncertainty. I think it's, concern about, the company's health and their job and the family's health. And we've really, I think very early on in this process, I've reached out. I haven't talked directly to every employee in the business, but a great number of them. And it's mostly been about, we're going to, these are going to be some tough times. We'll be making difficult decisions. But the conversation was, how are you? Is your family healthy? Is your family safe? We're going to get through the other side of this. If you have questions, call me anytime. So it was really establishing and being new, relatively new into the business, establishing that personal link. And it wasn't about, hey, how much have you sold today? It was really, are you healthy? Is your family healthy? Anything we can do to support you? That's been important. I think it's had an impact. And now it's fun. We get, somebody gets, a sale or something positive happens. They're sharing that across the group. So I think it's a little bit of that when when the bullets start flying, you can only rely on the people beside you. I think we've that kind of mentality. And so from a culture, for what we want to drive to as a culture, that's been a positive byproduct out of a difficult time here.
It's interesting. By the way, you're being a human, and we're humans just caring for each other. I think that's really important. It's probably part of why it's working for you. But there are a lot of manufacturers that have, GE just came out and said they're not going to give any guidance for the rest of 2020 because they can't responsibly come up with it. But there seem to be a lot of suppliers. I'm getting a lot of stories from distributors that the suppliers are still hanging on to the revenue stream and calling up like, why did you stop buying from me? Or what are you going to do? I mean, what are you seeing?
Fortunately, we've had constructive dialogue. Parker being the largest supplier, I mean, they understand what's going on. They're reacting in their business and taking many of the actions that we are as well. So clearly they want us to sell more.
Sure.
But I think they're realistic in this environment, and we're figuring out ways to work together to get through this as partners. And that's good. I mean, I've been in this, this type of manufacturer distributor relationship for a long time. And I've had those discussions, right? I've had suppliers close down plants and can't ship product for a year and then yell at me for not growing my sales. I view this as a much more productive environment, and it's refreshing to work in that.
Well, you're fortunate to have Parker as one of your partners. Do you have any advice for somebody that's trying to deal with a major supplier and they're still hanging on to that number and just like being crazy?
I think you got to be fact-based, right? I mean, so often that relationship, when it gets antagonistic, is, they tell you don't sell enough. You tell them they're late on their shipments and they're too expensive. We believe in sharing information. Here are opportunities to grow. Here's where we're missing it in terms of customers that are dropping or declining. And it's to be fact-based. That's the only thing you can do. too often that relationship is almost all emotion, and it can't be that. And we at FCX, we were big believers in analytics, and we're driving that culture into MCE as well.
Great.
That's really solid advice for everybody that's listening. I mean, from Brent, I'm listening to my CPA, and I just grabbed this from Charley. It just bring data into the conversation. Thank you.
Absolutely. Yeah. Yep. Thank you very much, Charley. Good to be with you again, and best of luck to you, your family, and your team.
Yeah, thank you very much.
Yeah. Take care.
Bye-bye.
All right. Before I bring on our next guest, another reminder, our program today is sponsored by VersaPay. VersaPay ARC automates the entire AR process. And if you'd like more information, please visit versapay.com. And you'll see all they do. They are, particularly in this environment, are a critical tool. With that, also just a quick reminder that next week we're going to be joined by Mark Dancer of the Network for Business Innovation and also an NAW fellow, as Mike and Brent Grover are as well. Jennifer Murphy of Net Plus Alliance will join us, as well as Christian Wiltrout of SureWorks, safety master wholesaler in Canada, US, and also with operations in Europe as well. And Henry Bruckstein, with Campaign Stars, which he'll be talking about.
You don't have to tell him yet. It'll be a cool conversation. We know what he's going to say.
Thanks, Mike.
It's all right. It's hard to explain.
I know. I was trying to oversell there, but I think we're just going to move right in. I'm going to bring on board here Doug Savage. Doug is the president of Bearing Service, and he is also has been a long-time member of MDM's advisory board. Doug, if you want to bring your video up down the lower left-hand corner there, we'll see you. There you go.
Me?
Hey, yeah, welcome. And
Thank you.
Doug's joining us. So just as a quick intro, and Doug, I'm going to ask you to talk some more, but Doug's the president of Bearing Service, as I said, and the Detroit-based bearing and power transmission distributor. In addition, Doug's been very much a long-time leader with the Power Transmission Distributors Association, Bearing Specialists Association, as well as also with affiliated distributors too. And I know I talked with Doug yesterday. He's joining us from his cabin up in northern Michigan, where he's sequestering. And I love the pine.
Hey, hi to your wife.
Doug.
Yeah.
So thanks for joining us, Doug.
Thanks for having me. I wanted to get out of the Detroit area. And
well, you know what? Hey, Doug, can you turn up? You got a double thing going on there.
okay, how's that? Is that better?
That's beautiful. Yeah.
Perfect.
Uh-oh.
So go ahead. I'm sorry. Welcome. We can hear you now, but you can't hear us, I bet.
I can hear you.
Okay. We
can hear
got
you
you
too.
as well.
I just lost the, I must have clicked off the Zoom.
Well, we got you on video, so we're good.
Oh, yeah? Oh, you got me? So I don't have to watch. So anyway, yeah, thanks for having me. Oh, here it is. Okay, I got it now. But yeah, I did about 200 miles north of Detroit. I'm in my cabin, and when I originally got here, there were no cases of COVID. So now there's 5 cases and 1 death. But Detroit's doing a lot worse, and I'm keeping in touch with my office, you know, getting to be an expert using Zoom. So you know, basically Detroit's been having a real rough time with you know, one of the hot spots in the country.
Yeah. So how's your team doing?
My team's doing pretty good. We had one guy that had the virus and got out of the hospital yesterday and went for a walk, and he seems to be recovering. And we had another guy that went in last night for a test, and he was negative. So, you know, we're living on pins and needles, and, you know, we have all of our offices shut down to only 2 people in each office. Doors are locked. If people need something identified, we leave it outside, have them call us. You know, we're trying to keep our distance with the 2 people. We're trying to keep the same 2 people for the whole week. You know, we've got masks for everybody. Everybody has to take their temperature when they come in the morning and when they leave. We're trying to keep track of the temperatures. Some of these guidelines were given to us by the automotive companies.
Can you just tell us a little bit more about Bearing Service in terms of branches and
Yes.
your segments you serve?
Yes, we've been in business since 1943. My grandfather started the company, and my father, and I bought it from my dad's estate 41 years ago. And we're a 5-location. We have a central distribution warehouse, a 5-location sales company in the bearings and power transmission business. The majority of our business is automotive. Unfortunately or fortunately, sometimes the peaks are great and the valleys are tough when they all shut down for virus. But the other thing too is we do a lot with the tier 2 steel companies and such. So it's a pretty big economic impact here in Detroit when the automotives pick up.
So a lot of the news we hear is just how a lot of the automotive around Detroit shut down. What are you experiencing and hearing from your customers right now?
Well, we pulled our top 400 customers, and about 185 are still operating kind of on a normal basis where they're purchasing or where they indicated they needed to purchase stuff from us. We all, other than that, all the tier 2 and the automotive customers have pretty much ceased operations.
So is this just, Doug, is this just sort of like everybody's doing a giant timeout?
Yeah, they're doing a giant timeout. Actually, we did get a communication that some of the automotive plants are going to start accepting material, and they're going to start back up at the end of April, or to the 27th of April. And the automotives are making their own masks and protective equipment, and they're going to do the same thing. They're going to check temperatures at the gate. It's going to be unbelievable. I don't know if they're going to be able to bring back all of their people, but there are some vehicles that are a necessity. Ram trucks and things like that are made in the Detroit area, and they need to get those out there. They don't want to lose market share, and it's going to be interesting watching people in hazmat suits build automobiles and build the trucks.
Yeah.
Yeah, you can't make this up, man. You just can't make it up.
Nope.
Geez.
Um,
What about suppliers? What are you hearing? What are your conversations with suppliers like right now?
Well, I've had a lot of suppliers reach out to me, surprisingly. Being in a hot spot, maybe that's kind of why. But I have talked to 5 of our major suppliers, and of course, they're all concerned and they're all willing to do what I need them to do. They don't want to lose market share. They want to make sure that they're working with me. They don't want to lose their position in the market. I actually was talking to a couple of them about the sales incentive programs, rebates, things like that, how they're going to, with these 2 months basically, knocked out, how are we going to be able to do a year-to-year comparison and things like that. Fortunately, one of my suppliers is Japanese, and their fiscal year ended at the end of March. So their rebate and sales incentive program was ended at a perfect time almost. But so all the suppliers are telling me how they're going to keep they're concerned about their salespeople going into the automotive plants and identifying material and helping our salespeople out. They don't really want to do it. They don't want to force their salespeople to do it, but if they have to, we've been taking a lot of pictures on cell phones and sending them in. They've been sending pictures on cell phones. It's amazing what we have to do in a pinch in order to, in order to facilitate business and help customers out of down issues. But the down issues aren't as urgent right now, which is a good thing also.
Yeah.
One of the things that we did one of these kind of meetings with some distributors in Spain, and there have been a couple suppliers in Spain that, in terms of their year-end rebate, because Spain had it pretty much like what you had. Everybody was just forced to close, nothing could continue, and they had to stay out. And so what the suppliers are doing is they're adjusting their year-end targets that they had to hit by 11/12. They're just taking out that middle month that they were closed down. So it remains to be seen what people are doing, but they have to do something.
Yeah, that's a real good idea. And then how are we going to compare it to next year and such like that? Because I don't know. I know President Trump wants the economy to pick right up, and go back to normal. But I got a real feeling that it's going to take a while to have the economy turn back to normal and have people buying cars and making commitments and things like that until they know that there's not a second wave, or there's not, they're going to have a steady job. They're going to be able to do the things, and they're going to be able to move around and do the things that they are used to doing. So I don't think that's going to be able to turn on in a week or two.
Oh, we're all in violent agreement with you, Doug.
Yeah.
This is going to be with it. We're going to be, when you look back at 2020, this is going to be the dominant discussion that shaped the whole year for all of us. I think you're right on the money.
Yeah, you talked a little bit about how you're changing up some of your branch locations, operations, but what about your main office in Livonia there? How have things changed? Do you have a lot of people basically working from home now?
Yeah, actually, we have probably all but 10 people working from home. I mean, we have over 50 employees, so it's been a real learning experience. Fortunately, my son has been very good at getting laptops. We found out cameras were sold out. Video cameras were sold out, reasonably priced ones anyway. You couldn't find them anywhere. But anyway, we've hooked up pretty much everybody from home. We had an employee who came in yesterday. We had to reprimand him because we said, "Hey, listen, this is a serious situation. I know you want to work from your desk and you got stuff that you have to look up and stuff, but you can't come in. We are trying to do our part and trying to keep our distancing, and we want to make sure that that we're doing everything we can to stop this disease. We told you to work from home. We meant it, And that's
Wow.
kind of an unusual reprimand for a guy that's saying, "Well, I'm a real loyal employee and I really want to help my customer, and I got to get I got to get to the right, information, and I couldn't do it from home."
Well, I mean, you have to agree with his intention and commitment. It just, you're right, he can't do what he did. One of the questions that came in from our audience, Doug, was, have you been seeing any requests yet for extended payments from customers?
Actually, what's been really amazing is, and I'm not sure how the automotives pay, but we're still getting wire transfers. They pay us electronically, and we're still getting wire transfers. It looked like they may have set those transfers up, 3 or 4 weeks ago or whatever, but we've been still getting our payments from the automotive companies, which we thought would have shut off because, when they shut them down. But, that I don't know how long that's going to, hold out, because obviously we're not selling them anything, haven't been for a good 2 weeks now. But the thing is that we've got a lot of inventory accumulating in our branches for those plants, and we've special order stuff. We can't really cancel it, and we have bona fide orders for it, but it's starting to mound up to a pretty sizable pile of stuff.
It kind of feels, Doug, like you can't bring in a common carrier or a third-party shipper to get what's sitting in your warehouse out to your customers. Whenever the gates do open up, it sounds like you got to kind of turn on a dime and figure out how to go through all the protocols to get the stuff to your customers. Is that accurate?
Well, can you imagine 300 or 400 suppliers that these automotive factories have shipping all at once, everything? They only have 2 or 3 guys in receiving. I don't want my, receipts being mishandled, because that's the greatest way to not get paid. And so we're thinking about some strategy. We've read the guidelines on what it's going to take to have our driver go over there and get, hard signatures for, for our most expensive stuff for sure. But anyway, we're trying to come up with a procedure so that, they don't want a bulk signature for UPS when they sign for 400 packages to be your proof of delivery. They don't accept that.
Exactly.
They don't accept that. So anyway, we're trying to figure out a way to, because I know that those guys are going to be inundated at the plants to try to get their material, to the right workstations and to the right areas of the machine repair and such like that, in order to make it as foolproof as possible, because anything that goes afoul, it turns up in a collection issue.
Yeah, it does. I mean, I mean, just gut feel, because I know you've lived with this for a while, Doug. Once they turn it on with all those suppliers, is it like a 3-day thing to get all that material received, or is it longer? I mean, how long is it going to take for them to get back into flow?
Well, I think they opened them up 3 days early, but I think it's going to take them longer than that, to be honest with you, because you know, there's millions of parts they need to, you know, keep their machines running. They're, you know, robots, and, you know, it's very sophisticated equipment, and the receiving job at an automotive company has gotten to be really complex over the years.
Wow. You know, I think a lot of people don't appreciate the complexity of these supply chains, and they just take everything for granted. And I think one of the reasons it's going to take a little longer than our president wants is because it's going to take a long time to put all these things back together again.
I totally agree with that. I don't know, you know, how that's going to happen, because unless they have a way to test everyone or something, you're going to have people in these hazmat suits working together, and I don't know, you're just not going to be as efficient with, you know, with all that protective garb on, and then, you know, taking your temperature, and, you know, and keeping your space. I don't know. It's going to take a little bit of time to fire back up. It just seems like it.
Yeah.
And some bumps along the way. So this whole thing is really crazy.
So Doug, I asked Charley this, our last guest, and what, you know, you've been through, you know, 40 years of these cycles as well. What's different about this for you in terms of how you're framing your response, and how you're mapping the next 60, 90, 180 days out?
Well, the thing is, it's shot down so quickly. I mean, I know 2008, it took a month or two for things to wind down when the financial crisis hit. But this, it wound down, and I remember one of the stamping plants had a COVID positive guy in their plant and sent everyone home that day. Done. And so the speed in which it happened, this one was quicker than ever, that the way we saw the auto shuts down. Now, I hope that there would be a V curve and the speed would come back that quickly, but there's just no way. I just think that it's going to, you know, they're going to take critical operations first, and, you know, they're going to, you know, take a engineered approach of the way they're going to bring their production back to speed, because there's a lot of people involved in producing the cars. So a lot of people, a lot of potential for COVID spread and everything like that. It's in Detroit is where the most plants are, and those are the ones that are, you know, most labor intensive also.
You know, I think you're right, Doug. I know the ITR economic guys that Brent was talking about are saying it's a V, and I hope they're right, but you know, they talk, is it a V, a U, or an L? And I think you're right. It's going to be a U. And the only thing I don't know is how wide is the U going to be?
Yeah, I think the U is going to be wide. You're talking about the, you know, each person has their own sense of, you know, avoidance of the disease. And so, you know, we've seen some of our warehouse guys, you know, some of them, hey, no problem, I'll do all that and whatever. And then we see people that say, no, I have a family of 3 young kids, and you know, I got all these responsibilities, and I would prefer not to be put on the schedule with anyone else. And so I think that each person has their own set of issues. And you know, I a week ago reached out with a letter to all my employees about, you know, how we could be more sensitive to their family. Call me if they're you know, worried about the environment. Call. I can't think of everything. My eyes aren't in every one of our offices. If there's any way to sanitize better, if there's any way to and to make it a safer environment, please let me know. And so we've been having, our strategy team's been doing a great job. We've been having weekly Zoom meetings, and we've been discussing all the problems, and as they relate to one branch, then we can make the change for the whole company. And so I think we've been as proactive as we can be, as quickly as we can be, to ensure the safety of our employees, and of course, and keep safety, not infecting one of our customers. God forbid we ever would do something like that.
Yeah.
Doug, I'd like to say something to the audience that's listening, and because they may not have appreciated what you just said. What Doug is doing, Doug's building a playbook for the new normal. When you go to find a problem in a branch and you figure out a solution, you can trade it to other people. There's going to be a new playbook. This is never going to go back to where it was in January, but doing that innovation is everybody should be following that same pattern. So, Doug, thanks very much for sharing.
Yeah, that was a great thought, Doug, and also thank you for joining us. I really appreciate you taking the time and the effort. And as always, it's good to spend some time with you. And best of luck to you, your family, and your team.
And it looks like they're making a nice dinner back there for you.
Yeah, it does.
Yeah, they are. I can smell it. I see them every once in a while going behind me, but that's kind of the issue. I don't have a huge cabin up here, and it's a fishing cabin more than it's a big house. So anyway, thanks for having me, and I hope to see you guys soon.
Yeah, thank you, Doug.
Friend.
Take care.
Bye-bye.
Bye-bye.
All right. Our next guest here is Sam Petillo. He's the president of Singer Equities, and Sam, welcome. I think if you're there, you are.
There I am.
Great to be with you today.
Yeah, thanks for having me.
Hello, Sam. Good pleasure to meet you.
Yeah, you too, Mike. Sorry I'm not in a cabin like Doug. That would be nice. I'm just the opposite. I'm holed up in a house with my wife and 3 daughters. Fortunately, they haven't killed me yet. Our executive management team was just talking on our daily call the other day, and our COO asked all of us, what's the first thing you're going to do when they lift all these travel bans and you're able to go outside? And I said, I'm going to start traveling again and visiting all of our businesses. It's good to get away from my family as quickly as possible.
I actually, it's funny you say that. I looked at my briefcase or my suitcase, and I go somewhere every week like you do. And I actually talked to my suitcase this morning and said, we'll be back on the road soon. You just got to wait.
Yeah, I don't think it could come soon enough. That means the virus is gone by then.
So Sam, I'm going to ask you just to tell us a little bit about Singer Equities here, but I also just want to let people know that you are also the current president of the Power Transmission Distributors Association. And I know we'll probably touch on it here a little bit, but actually we were supposed to be together here in a couple of weeks in the Bahamas at the Atlantis for the annual meeting of I'm sorry.
NAHAD.
Thank you.
That's all right.
Molly's going to kill me now, but
it's all made out of rubber.
You're going to pay a price for that, big guy.
I know, big time. So
don't mess with Molly.
Let me restart and just
you're
say
in trouble.
You're the current president of. I'm catching up from our last guest. So you're the current president of the National Association for Hose Distribution, but I got the part about us being together in a couple of weeks, and of course that was canceled. And I know we'll touch on that a little bit later, but please tell us a little bit about Singer.
Yeah, I will. Singer Equities is a company that's part of SBP Holdings. And the other 2 companies that are part of SBP Holdings is Bishop Lifting Products, who sells, fabricates heavy lifting rigging products, also rental as well down in the Gulf Coast. And the third leg of the SBP Holdings stool is Dakota Fluid Power, who in the upper Midwest has multiple locations. And just by their name, they're in the fluid power industry, and they sell and fabricate and hydraulic hoses. They build their own power units and do a lot of hydraulic repairs, both on site and in the field as well. So a lot of high touch from all 3 of our businesses. In total, SVP Holdings is about 1,600 employees. Singer Equities has 725 employees, and we specialize in the distribution and fabrication of industrial hose, hydraulic hose, conveyor belt, and also gaskets and other assorted rubber products. We not only fabricate in-house, but we also do a lot of service on the hoses, do a lot of repairs on hydraulic hoses, industrial hoses in the field, and we also install conveyor belts. So a lot of our value is the higher profit for us that we offer to our customers when we're out in the field doing that type of work.
Yeah. And just for a little bit more context, is that Singer is, it really has been one of the primary consolidators in that particular industry over the years, but specifically with adding on smaller independent distributors, but really providing a centralized back office, but really a very entrepreneurial culture. And I know you're going to touch on that too, but I think it's important just to kind of at the outset so people have that context as you talk a little bit about how things are going.
Yeah, absolutely. We do run a decentralized model. We have 15 Singer companies, and then through those companies, we also made many bolt-on acquisitions throughout the years. I think for a total of around 25 acquisitions. Some of those other acquisitions of smaller bolt-ons are folded in under those 15 platform companies. We have 58 locations, and you're right, through that decentralized model, we say it's decentralized, but we've put a lot of guardrails on what we do. We make sure that we work in a collaborative manner, and we've hired some pretty smart people from the industry that have helped us with the toolkit that we use, the benchmarking toolkit. So we apply that to all of the businesses in one form or fashion. And when it comes to the pricing analytics, when it comes to freight recovery, when it comes to price negotiation and product consolidation and PBL and all of that, we make sure that all that team's involved. So we're not just letting them run 100% independent, but we're using the power of the entire group to benefit everyone. And
yeah. Sam, what is PBL?
A private brand label, sorry. Our private brand products.
Yes.
And most important question first is, how are you and your team doing?
We're doing well. This has been, you know, for us, it's come in phases. Early on, we got a crash course lesson in COVID-19 because back on March 10th, we had an employee that tested positive for COVID. And unfortunately for us, this was before all the articles came out to tell you, from an HR perspective, how you're supposed to manage it, and, how you're supposed to manage sick days and everything. We were flying blind at the time. I got a call on a Tuesday night, and the next morning I was on the phone with our attorney, who basically told me we were the first client to call them on this matter and couldn't really help too much. So I think we took a team approach, and, I reported it up at the ladder, and our executive team, and even our private equity partner, who's been great through all of this, AEA out of New York City. They were informed as well, and we took a team approach to this, and we just, we opted to do everything in our power to make sure that we protected that employee first. We made sure we were very transparent with the employees of that particular company. This employee in the state that he was in was actually the fourth person tested positive in that state, and the first one of community spread. So, like I said, it was very, very early on. So we erred on the side of caution. It was in a small branch where he worked, and we shut that branch down immediately next day, quarantined the other individuals that worked at that branch. And like I said, it turned out really well. The employees healthy again, and the branch is now open. But we learned the hard way how to deal with this virus. So that also turned the light bulb on for us. It made us realize that this thing is real. So early on, we were one of the first ones to jump on protecting employees with the protective equipment, getting Purell to each one of our facilities. We started daily calls. We had our general managers of all the businesses on the phone, explaining to them, again, full transparency, what had happened. It might have scared them, but I think that tactic worked because we moved pretty quickly from that point forward back in early March.
Well, if you had an impact on the 10th of March, you're definitely at the forefront of this whole thing. I mean, I've got to say, because there are still a number of distributors, and we've kind of talked a little bit about on these with the earlier guests. What advice do you have for somebody that hasn't really gotten to this yet? I mean, knowing what you know now, what do you wish that you'd known on March 9th?
Well, we certainly would have acted sooner. But my advice to anybody is this thing is real, especially if you're in a state where the virus hasn't really had that type of strong community spread. You know, our employee was the 4th in the state to have it, so it certainly can happen to you. I think that we were fortunate that that employee worked at one of our smaller branches and no one else got the virus or tested positive. And I think that was because we acted fast. So that would be my advice: is err on the side of caution. You know, buy all the disposable gloves, get all the other protective equipment. Make sure you don't let too many visitors or no visitors into your facility, and maybe one person at your counter at a time. If you have service counters, and just be very careful about that. Because
I've heard the line that said it's not a question of if you're going to have an infection, it's a question of when.
Yeah, for sure. You know, and early on, we knew what we kept saying was, you know, the chance of getting the virus is very, very, very slim. But the chance of your business is going to be impacted by the virus, you know, from
It's very high.
Economy standpoint, it's 100%. It's 100%.
Yeah.
We've seen that both in the U.S. and we also have 2 companies up in Eastern Canada as well. And they're seeing quite the outbreak there over in Toronto and the Quebec area.
No.
Yep. It's very local. I was interested in the point that you were really trying to underscore to people, if you're in an area that hasn't been hit with a lot of infections yet, it doesn't mean you can ignore it. It means you need to get ahead of it. Did I hear that right?
Yep, that's exactly it.
Yeah. Reed, you're in a lot of diverse markets around the country. What are you hearing from customers? And maybe, you know, you mentioned you've got some oil and gas type operations. I know we've talked before. Can you just talk a little bit about what you're hearing from some of the different companies and segments out there?
Yeah, well, first I want to mention, you know, oil and gas for Singer is, you know, less than 10% of our overall revenue. So I think we're pretty fortunate there, but that doesn't mean we haven't been hard hit in the Gulf. You know, general industrial, construction, aggregate, food, beverage, you know, gas, cryogenic, and pulp and paper. Those are our major markets for all of our product segments. And, you know, I could start down in the Gulf, and we, you know, from a geographic standpoint too, our footprint covers the Northeast, Mid-Atlantic, Eastern Canada, Midwest, the Gulf Coast, and also in the West. And starting the Gulf Coast, yeah, I mean, it's a double black swan event. I mean, between the coronavirus and what's going on in oil, you're hit really, really hard down there. And we service, you know, both the MRO, but also the OE market down there. We have some major oil and gas OEs that are down, and we're used to those types of cycles. But when you couple it with the virus, it's just an area of uncertainty, and we reacted as fast as possible. You know, I heard your other guests on the call today say, you know, act early, and especially those that are PE owned. Those are the ones that act the fastest, and we are definitely not alone in that. And we had to react the fastest down in the Gulf Coast through all the SBP businesses down in the Gulf Coast. Both Bishop Lifting and Singer Equities had to act pretty quickly.
The oil and gas has been breathtaking, absolutely breathtaking. And I think it's going to take a long time to come back, even with the Saudis and Russia supposedly shaking hands yesterday.
Yeah, and you know, we pay close attention. We subscribe to what ITR puts out, and they just put one out yesterday, and they even addressed the negotiations between the Saudis and Russia. And even though they know they're going to the table, ITR still has a pretty somewhat pessimistic forecast as far as the timing of oil and gas coming back. And we're taking that same approach with our cost outs and how we're going to manage the business moving forward, and especially our forecast models of revenue moving forward into the summer and even further than that.
What about upper Midwest and that area?
Yeah, so the Midwest, and we have a lot of our companies and branches in Ohio and Pennsylvania, and there's been a lot of industries hit there. Not all customers are closed, but there were some customers that had some short hiatus types of closing their doors. Some are already back open, like the aggregate customers. Some of them weren't necessarily defined as those essential businesses, but then some of those industry groups went and lobbied, and they got their way, and some are open again. However, for our conveyor belt business, both up in the Northeast and also the Mid-Atlantic region, where we do a lot of conveyor belt on-site installs, a lot of those companies, like our own company, they don't want to allow anybody on their site, you know, especially, you know, for a conveyor belt job. We work side by side with their team.
Right.
And we're taking the old belt off, putting a new one on, and they're just not letting those types of contractors on site. So what they've done is they push back a lot of those capital projects and conveyor belt replacement and repair jobs. Even if their business is still open, we're just not allowed on property right now. So it's definitely impacted our revenue there. Military, Marine, still very strong for us. They continue to stay open, and we're not only deemed essential, but we're getting letters from them to ensure them that we're going to stay open, and we're in business to help them with those major repair and new ship build projects over in Newport News shipyard area.
What about like the Dakota up in that area?
Yeah, thanks for asking. I was going to mention Tom. Dakota is doing really well right now. We're real happy for them. You know, Singer and Dakota's really closely aligned in products and even vendors. Gates is a big vendor for us and a big hydraulic supplier to them as well. And they're doing really well because of the strength of the ag market up there, and the OE business has still been very strong for them. Their counter business and even repair. From all reports I've heard from my counterpart over there, that they're still strong.
That's good to hear.
The one interesting thing about conveyor replacements is that it's kind of like when they break, they have to replace it. I mean, they're out of business if they don't.
Right.
So when they open this up, is all of a sudden all your technicians and teams that put it in, they're all going to be doing 5 jobs at the same time? How's that going to work?
Great question. We've talked about that. And if it does go gangbusters, or they're all going to want it at once, I think we're just going to have to work with those customers, and they're just going to have to understand that we only have so many service crews to go around. We do have a lot of teams down there. We furloughed some guys, which will allow us to bring them back.
Right.
The team back up when the time comes. And you know, I think that's a better problem to have, Mike, having
I do too.
than not enough. So I think if there's a turnaround there, that's where we're going to see, you know, probably a bigger uptick than what we feel the turnaround is going to be for the rest of our markets. We think it's going to be a slower turnaround, not necessarily a big V ramp up.
Right. But well, the thing is kind of, it's complexity. It just adds more uncertainty. But in the business that you're in, my sense is a lot of the bits and pieces of your business are going to probably come back faster than others, simply because that MRO thing. I mean, if a metal hose breaks, people die. You know, some of the stuff you guys are doing is really serious. So people they can't run a plant if they don't have it.
Yeah, you're right. And the chemical business is still relatively strong, and a lot of them are producing chemicals, you know, because of the agents that they're putting together to fight this, you know, coronavirus, you know. So there's some. I actually have a buddy that's he's a manager of a plant that's a chemical plant that's making mixing certain chemicals, which he can't share with me,
Right.
To supply to the government and some other companies to fight the virus. So, you know, our company Unisource is very heavy in the gas and cryogenic and Teflon and metal hose, and they're still booming right now as well. So to your point about those types of critical products and those critical applications, yeah, we're still seeing some nice volume from those as well as the food and beverage market.
Yeah, Sam, we're coming up to the end of our time, but we talked a little bit earlier this week.
It did go fast, didn't it?
It did went really fast, but we talked a little bit. I'd like to get your take a little bit in terms of what you're thinking about in terms of the impact on this industry as we move forward a little bit.
Yeah, I think same as what we heard earlier today from the other speakers. I think we're all going to have to take a look at the new architecture of our business moving forward, and you know, how do we turn our salespeople into hybrid salespeople? You know, utilizing inside salespeople to contact customers. I think we're just going to come out of this crisis a lot wiser and doing things a little bit different. You know, our sales team is right now they're using the time to get trained on HubSpot and utilizing the training that's being offered by our supplier partners. But at the same time, we're also learning how to give them leads and use the time to call out to new customers. And you can't do that driving around in a car with an hour in between appointments.
Yeah.
No.
And I know, you know, it's what Charley said too, because I know your company is very analytically driven, and you know, we were talking that you're just continuing to move all those programs ahead as well, both on the technology side, but also in terms of analytics in the company.
Absolutely.
All right. Well, gosh, I really appreciate your time, Sam. It was great to talk. I'm sorry I won't see you in a couple of weeks in the Bahamas.
Yeah.
But I hope we're together. I hope we're together again soon. You bet. Take care.
Yeah.
Sam, take
Thanks,
care of
guys.
yourself.
Appreciate it.
Nice meeting you.
Have a great holiday weekend.
You as
too,
well.
man.
Happy Easter.
Bye-bye.
All right.
Every one of these guys, we could have done at least another 10 minutes.
Yep. All right. So our next guest, Reed, welcome.
Thank you, Tom. Thanks for having me. Good to
You
see
bet.
you,
Reed.
Tom and Mike.
It's great to see you. And Reed Anderson is a managing director with Houlihan Lokey, an investment banking firm. And Reed, I'm going to let you take it from there and just tell us a little bit more about Houlihan Lokey and what you do and your focus and specialty. We've known each
absolutely.
other for many years.
We have. I've been doing this for a long time. At Houlihan, I focus on specialty distribution. We are an investment bank. We're about a $3.7 billion market cap international investment bank, active in both M&A, capital raising, as well as financial restructuring. So we have the unique distinction of being a leader in M&A activities. We did 184 transactions in the US last year, more than that globally. On the financial restructuring side, which has become now a much more active part of our practice than it was a month ago. We are the leader there. We've done 12 of the 15 largest financial restructurings. We do everything there from formal restructurings to liability management, which is talking to your banks when you get into some of the challenges that you and Brent Grover discussed at the beginning of this show. And then distressed M&A. If you can't deal with those, what happens next? So soup to nuts really on the capital structure and looking for solutions for distributors across the board. So historically, the last dozen years, we have been rocking and rolling on M&A and capital raising. And now to the points that everybody's talked about, that's slowed down pretty quickly here. The brakes have been more than tapped. And we're having a lot more conversations with folks that are interested in looking for preservation going forward and understanding, what their solutions might need to be as this progresses, which there's more uncertainty than there are real answers.
There is, but what if you were just going to describe the last 2 weeks of phone calls and conversations you've been having? What's different in the last 2 weeks from the beginning back in January?
Yeah, I'll tell you, it's been totally crazy. So we've been on one hell of a ride in the M&A and capital raising world for a dozen years. And, everybody knows the trees don't grow to the sky, but they kept trying. Every transaction, a higher multiple, somebody was beating another guy.
Okay.
It was a great time to be a banker, great time to be selling a business. And that all stopped. Everybody always asks, what is it that's going to derail an economy? And it's always something that's a surprise. And this was a surprise. So I would say, Mike, over the last 3 weeks now, the conversations have really evolved. First it was, what the heck is happening here? What am I supposed to do? What does this mean? And nobody knew at the beginning how big, broad it would be, what might happen to the economy. A lot of people didn't foresee the government shutting down huge sections of the economy. I mean, restaurants, hotels, they're just shut down. So, that was something that people were trying to evolve through and understand. And then as it started to become clear that this was a major issue, people were trying to just figure out, how do I stop my head from spinning? How do I preserve myself? And I would say over the last 2 weeks, we have now gotten into a situation where if you're a national or even a regional distributor, you had the opportunity to see what this current environment looks like, at least in part, at least in segment. Maybe your area or your full geography hasn't been hit with the same lockdowns, but you've seen it in certain segments of your business to understand what this is going to look like going forward. And so we're now just starting to have more credible conversations with people. It's tough to build a foundation on sand, and that's where we've been. We're just now starting to figure out where some of the, where some of the key balancing points are to start building upon going forward.
I've got to ask one technical question that's way outside of my wheelhouse, and you're my investment banker today. Somebody told me that the companies have been drawing down their credit lines when they've been pulling the cash out, that the banks are getting a little concerned that only about half of that is showing up in deposits. And there's maybe with all the federal loans they're trying to get through, there's going to be some that this person was telling me that there's a lot more uncertainty in the reliability of the banking and what they can do than I would have thought. So is this just somebody? This is somebody I drink with, so I don't necessarily know they're always right.
Well, there you go. I don't know how many drinks you had before you had that conversation. No, I'll tell you this. And there was some conversation earlier in the show about private equity-backed companies and non-private equity-backed companies. The businesses we're talking to are all sophisticated businesses. Okay. They've all drawn down on their revolvers. I mean, it makes sense to preserve your liquidity. Some may have drawn down more or less on those revolvers, but it's under the construct of protect yourself and then figure out what needs to happen next. So they're all making sure that they have ample liquidity or as much liquidity as they can have today. If they're in a position where they don't need that cash and want to give it back in the near term, God bless them, they've done it. But I think a lot of folks have learned, particularly private equity businesses, through the 2008, which now I guess we'll call the financial recession, right. That liquidity was paramount there. And those that drew down their revolvers at that point, they got the money quickly. Those that didn't, oftentimes the banks clamped down on them and changed the terms because of the unique situation that we were in. So here I think that, particularly sponsor-backed companies have really taken, I don't want to say an aggressive approach, but a prudent approach to make sure they have ample liquidity. And, they're going to see what happens here over the course of the coming weeks and coming months. And, we're hearing a lot of really smart people give very, very different perspectives on what they think is going to happen. And so it's difficult to fault anybody. I think right now in the conversations we're having with CEOs and partners at private equity groups, we've got to preserve what we have to make sure we can fight another day and we can make it through this tunnel to serve our customers, to be responsible to our employees and our associates, and to try to have as strong a relationship as we can with our suppliers. And unfortunately, some of that does mean on cost cutting today or furloughing or a certain dynamic that nobody wants to do, but you have to do to protect your business.
The thing that I grabbed out of that is that you were very clear in the sequence. You said, protect yourself first, then figure out what to do. So
you have to. You can't, I think you said on the first one of these events a couple of weeks ago that experience is the hardest teacher because you get the test first and the lesson later. Well, I think this is a situation where protect yourself first and then figure out how you protect yourself after the fact, but you're going to need that liquidity going forward because that's where you're going to get tripped up first if you get tripped up.
Yeah.
Go ahead, Tom. I'm sorry, I got excited.
That's all right. Were you able to be on the call for when Brent was on?
I was.
So I just wanted to follow up because, he mentioned some things, and this is coming back to some of the restructuring and debt management. Brent touched on a couple things in terms of some specific tactics in that. And I just wanted to get your thoughts around any part of that conversation. But secondly, just in terms of your conversations, any thoughts or tips in terms of, specific areas where there might be some good ways to and flexibility for negotiation?
Yeah, so listen, I think Brent's takeaways were all dead on. I mean, there are certain dynamics today that are occurring that, survival is key. Getting to the end of that tunnel is key. And I think when we get outside that tunnel at the end of this, wherever it is, whenever it is, duration is the biggest question. Because there are a lot of businesses, if this lasts 2 to 3 months, are totally fine. They'll make they've gone through the tough decisions, they're going to be okay. If this drags out in some form or fashion for 6 months or longer than that, it starts to impact businesses in different ways. And so, the duration is really critical as it relates to survival and what that protection looks like. But I think when we come out the other side, you are going to see some of the dynamics that Brent talked about. I mean, e-commerce is something that has been a huge topic in distribution. People have blamed Amazon for years as it relates to that challenge. This is an even greater accelerant on the e-commerce dynamic. And so people are getting more comfortable with e-commerce. I had never been on Zoom at the beginning of March, and I might have used it 100+ times since then.
Yeah.
And that's me talking to, senior executives at large distributors or private equity groups, and everybody's in their sweats, but they're all using the Zoom because we can't get together. And so you're going to see this e-commerce dynamic be very, very significant. I also think that this is a traumatic event in all senses of the word, but this is a disruptor as it relates to relationships between distributors and their customers. And so I think that this becomes an even bigger catalyst for those that have a true value proposition in their business to demonstrate the differentiation. And the lower your value proposition to your customers, you may have been hanging on more because of some of the relationship and some of the dynamics that historically you've had with your customers. This is an abrupt change that serves customers to look at their own survival as well and try to figure out if there are other solutions that are going to be more beneficial to them, because a lot of our customers, I say our meaning distributors' customers, are hurting too. If you're distributing into the food service space, you have a lot of restaurant owners, and those restaurant owners may love you, but they are going to be in a very different mindset when they come back than they were before. And they're going to be in survival mode. So it's a shifting of psychology that I think is going to create both a move toward e-commerce because of what this has all done to social distancing, and two, just a further bifurcation between those that can demonstrate a value proposition and those that have less of a value proposition. And I think you will see coming out of this substantial market share consolidation in different industries. Obviously, every industry has its own dynamics. I'm speaking very generally here, but I think you will generally see significant market share consolidation on the other side of this, either through M&A or attrition, because it's not just getting through this that's key to the distributors, it's then ramping up in a productive, efficient manner to be able to service that demand and that customer on the other side. It's a twofold challenge that distributors have here.
One of the things we found coming out of the quote Great Recession, which I'm sure won't be called that anymore, we found more distressed distributors coming out, because when you're going into the recession, you're generating cash as you go down, but they're not aware that they were losing their working capital, and then they all just run out of cash as soon as the market came back, and there was a bunch of ugly things that happened, and it's probably going to happen again.
Absolutely. And it gets right back to the comments that Brent was making specifically about your balance sheet. And you think about, your revolver in particular, and if you've got an ABL, well, what's the borrowing base for your ABL? It's your inventory, which you're not investing in and you're running it down. It's your AR, and hopefully you're getting paid, and that's decreasing because you're getting paid. But if you're not, it's being aged out, and that affects your borrowing base. So that's where the liquidity becomes the challenge. And, God forbid you get into a situation where you do need to look at liability management with your banks, or you do need to look at some type of restructuring or even a distressed M&A. As a business, you are better off having the cash than having the ability to theoretically draw that cash.
Right.
It's the possession. It's the possession is 9/10 of the law. Well, it's 100% of the law in this case. So when you have the cash, you have the cash. And that's why you've seen others draw down to protect themselves for the future.
Reed, you have successfully burned it into my memory. It's all about the money. So I keep asking questions, Tom. I should probably give it back to you because it's your show.
Go ahead. Go ahead.
Well, so let's say that I've got a good balance sheet. I've moved quickly. I've got my company positioned. We're doing all the things right. and we're taking care of our employees. We're starting to come back out of it. We want to grow. There's a lot of distressed companies. How do I look at that in terms of who do I want and who don't I want?
So it's a great question, and everybody's very focused on the uncertainty and the negatives today. And that's the right thing to be focused on, because you've got to protect, as we talked about. But I do think that as this starts to turn, whenever that is, you're going to see activity in the M&A world, in the market consolidation world, particularly strategic consolidation here, as some of those businesses may be great businesses, but may not have the capital to ramp back up. And so you'll see standalone businesses that will want structured finance, where somebody can come in and give them a bridge loan to help them grow the business. Right. Maybe it comes in structured equity. Maybe it's some kind of a debt instrument, that sits behind a first lien or a second lien kind of piece of paper. But it's some kind of a structured paper that allows that to come in, and an investor would do it. But in other cases, I think you'll see a lot of business combinations here, where some folks historically might have said, we've been competitors, and maybe we've danced around the idea of coming together to be a leader in a geography, to gain complementary geographies or products. I think you will see a lot more people saying, we have a better chance together than we do apart. Let's bring these businesses together. There's probably synergies. So I do think that there will be strategic combinations, both of similar sized businesses that see an opportunity to survive that's greater together than independent, as well as some of the larger businesses in each of these segments buying some of the smaller businesses as they may struggle, or as they may look to say, hey, I'd rather have a bigger partner, have a bigger play to go out and tackle. And that's the way that I'm going to be able to accelerate coming out of whatever this is that we're in the midst of now.
So in terms of seeing that activity, from the theoretical magical point that the thing starts to turn around, are we going to see it's going to take like 6 months or a year to build up to that level of activity, or it's going to happen faster?
That's the I guess now with the stimulus package, that's the multi-trillion-dollar question. I think the answer really is both. The M&A market's not going to look like it did before we came into this. The market's been on fire, and everybody's been buying. Private equity's been very, very active. I think you're going to find some transactions early on. Particularly if this goes a little while and it starts to come out, the longer this goes, the more distress there's going to be in the system, and the more you're going to see less elected M&A occurring and more required M&A. So distressed M&A. If the business can't survive, it may have a lot of key attributes. It can't fund itself, and it gets bought by somebody else. So I think you will see that as the front end here. And then as things start to turn around, I do think you'll start to see elective M&A, people making an affirmative choice to want to sell a healthy business because they can grow more effectively with the support of a strategic or some kind of a financial investor. The question then, which is a whole nother segment, what does the valuation look like there? Because this has been a disruptive environment, and valuation in certain segments has ticked up as we've seen it. Well, we've just shaken the cube, and now we have to reset where that is. It's not just a question of multiples. It's really a question of what are the earnings that you're buying off of, because everybody's earnings are going to be impacted, and how are the earnings going to come back? There's a bigger philosophical question there that buyers are going to need to understand.
Yeah.
See, you're a smart guy at this. When people have been asking me about that, I said, don't ever try to sell your house in a recession. That's about as sophisticated as I get. So
don't choose to. That's right. And I would still say, that I think there are going to be a lot of transactions that are going to be non-elective, but there will be some that make sense. And, we're still talking to a lot of people that are very, very interested in making acquisitions. The question will be when and how.
Yeah. Reed, thanks so much. I really appreciate the time flew by. Always good to visit with you. And I wish you the best to you and Moira for the weekend. Happy holiday week.
Thanks to you guys for having me on, and thanks for doing this, because I think this is a great resource to distributors across the board.
Thanks
so much. We're all trying to figure it out. Yeah. Take care, man. It's good to see you. Take care.
Have a good one, guys.
Thanks, man.
Mike, we're at our time. Thanks again. I really appreciate Appreciate your help with this. We'll be back next week. And as I said, we've got a great program lined up. I won't go into the details. We'll be sending a follow-up email with the details on that and our guests. We also, you'll be able to download the slide that Mike shared at the beginning here, and also a recording of our program today that you'll be able to get. I'd also like to thank VersaPay, our sponsor, for helping to enable this program as well. Mike, really quick, your last takeaway, please.
I learned a lot this week, and I think what we're doing and other people are doing, you just need to talk to a lot of people. Nobody's got a magic answer, but just it takes a village, you know. Sorry, there's a better way to say that. That was my takeaway.
You know, we're all looking for analogies. I guess the difference between last week and this week for me is that it's really it's like driving around in the fog, and the first couple of weeks the fog was really thick, but every day there's a new data point, or whether it's around the the specific cycles and hot spots and all these, sort of the whole cadence of the epidemic itself on a health, but then there's a whole economic issue as well. And it's still cloudy, it's still foggy, but at least we're making progress. And where 2 weeks ago there was absolutely no clarity, there's a little bit more clarity. We can't bracket it, but at least there's clarity around, people are more forward looking. And I felt our conversation this week was around that as well. The focus, Charley's comments around just, he's got his team focused in terms of what they're going to do this year, and really shifted, adjusted their plan as they needed to, but it's not derailing what really the key things in terms of moving the business forward.
Yeah, exactly. Well, the same thing with Doug and Sam. So are you playing it to win or playing it not to lose?
Yep, absolutely. Thanks, Mike. Have a great Easter weekend, and I'll see you next week.
Take care, my friend. Bye-bye, everybody. Have a safe weekend.
Thanks for joining us.